You always hear about investing. You're told to start. Everyone seems to be doing it. But nobody ever actually explains what it is. So today, that changes. By the end of this video, you'll understand exactly what investing actually means. You'll know how people in the UK can start with as little as £20. And most importantly, you'll learn the one mistake that stops most people from ever beginning. Because investing is not just for rich people. It's not just for people in suits, and it's definitely not as complicated as it's made to sound. You just need someone to explain it properly. So let's do that. Start with the simplest question. What actually is a share? Imagine a pizza. A company is the whole pizza. When a company sells shares, it is cutting that pizza into thousands of tiny slices. Then it sells those slices to the public. When you buy a share, you own one tiny slice of that company. That's it. That is what a share is. If the company does well, your slice can become more valuable. If the company does badly, your slice can become less valuable. You are not just buying a random number on an app. You are buying a tiny piece of a real business. A business with customers, products, employees, profits, problems, and potential. So when people say, I own shares in a company, what they really mean is I own a small slice of that business. That's the first mystery solved. And the stock market? That's just the place where people buy and sell those slices all day long. Some people are buying, some people are selling. The price moves up and down depending on what people think those slices are worth. That's why the market changes every day. Not because investing is magic, because millions of people are constantly deciding what companies are worth. So now you understand shares. But here's where investing gets much easier. Because you don't actually have to pick one company, and that changes everything. Instead of buying one pizza, imagine buying a tiny slice of every pizza in the entire restaurant. That is basically what an index fund does. Instead of buying one company, you buy hundreds or thousands of companies at the same time. So you are not betting everything on one business. You are spreading your money across lots of businesses. That is why index funds are so powerful for beginners. They remove a huge amount of guesswork. The S&P 500 is an index of 500 of the largest American companies. The FTSE 100 is an index of 100 of the largest UK companies. And a global index fund goes even wider. The Vanguard FTSE All-World ETF holds over 3,700 companies across developed and emerging markets. One investment, thousands of companies, across the world. That means you could own tiny slices of businesses in America, Europe, Japan, the UK, and emerging markets, all inside one fund. That matters more than people realize, because the UK stock market is only a small part of the world, about 4% of global equity value. So if you only invest in the UK, you miss most of the global opportunity. A global index fund spreads you across far more of the world, and the fees can be tiny. A globally diversified index fund typically charges around 0.07% to 0.25% per year. That's not zero, but compared with many expensive funds, it's very low. And here is the part that surprises most people. The simple, boring fund often beats the clever, expensive one. Most active fund managers are paid huge salaries to pick the best stocks. They have fancy offices, Bloomberg terminals, research teams, years of experience. And yet, over the long term, most of them fail to outperform a simple index fund after fees. That sounds ridiculous, but it is one of the most important lessons in investing. Sometimes the simple option wins because it does less. It doesn't try to guess the next big winner. It doesn't panic every time the market falls. It just owns the market and charges very little for doing it. That's why index investing became so popular. Not because it is exciting, because it works as a simple, long-term approach. But then the next question appears. When do you actually buy? What if the market is too high? What if it crashes tomorrow? What if you start at the wrong time? That fear stops millions of people. And this is where pound cost averaging comes in. Imagine your favourite food goes on sale some weeks and is expensive other weeks. If you buy a fixed amount every week, say £50 worth, you naturally buy more when it is cheap and less when it is expensive. Because your same £50 can get you more food when it's on sale and less when it's not, over time that evens out your cost, and you never have to obsess over whether this week is the perfect week to buy. That is pound cost averaging. You invest a fixed amount regularly. The market goes up? Fine. Your money is growing. The market goes down? Also fine. You are buying more units at a lower price. That's the mindset shift. Falling markets are scary if you think short-term, but if you are investing for years or decades, lower prices can actually help your regular contributions buy more. You are not trying to time the perfect moment, you are building the habit. Same amount, same schedule, month after month. And this is where investing becomes much less intimidating. You do not need to predict tomorrow. You just need a plan you can stick with. But before the how to start part, there's one thing most people get completely wrong about investing. Because a lot of people think investing and trading are the same thing. They are not. Day trading is trying to predict what a stock will do in the next few hours or days. You are trying to profit from short-term price movements. That is speculation. It needs constant attention. It needs serious experience, and most people who try it lose money. Long-term investing is completely different. It is buying and holding for years or decades. You are not trying to guess what happens tomorrow morning. You are trying to let businesses grow over time. One is a fast game, the other is a long-term strategy. And confusing those two is one reason many people never start. They think investing means staring at charts all day. It doesn't. For most normal people, investing can be far simpler than that. And this is where the second promise comes in. How could someone in the UK actually start with as little as £20? A common starting point is a Stocks and Shares ISA. Inside a Stocks and Shares ISA, your investments can grow completely tax-free. The annual ISA allowance is £20,000. That does not mean you need £20,000. That is just the maximum you can put in each tax year. You can start far smaller, even £20 a month. Then many beginners look for a simple, low-cost global index fund, something that spreads money across lots of companies instead of one. Then you set up a regular monthly contribution, whatever is affordable for you. £20, £50, £100. The amount matters less than building the habit. Then comes the hardest part. Do not constantly touch it. Do not check it every hour. Do not panic when it falls. Do not think you have failed because 1 month is red. Investing is not meant to feel exciting every day. The whole point is to let time do the heavy lifting. Open the right type of account. Choose a simple, diversified investment. Add money regularly. Leave it alone. But there is still one mistake that stops most people from ever beginning. And this might be the most important part of the entire video. The biggest mistake is waiting until you feel ready. Waiting until you understand everything. Waiting until you have more money. Waiting until markets look calm. Waiting until the perfect moment appears. But that feeling almost never comes. Nobody feels completely ready the first time. Everyone feels unsure. Everyone worries they are missing something. Everyone thinks, I'll start when I know more. Then months pass. Then years pass. And the most powerful ingredient in investing gets wasted. Time. The people who build wealth are not always the smartest people. They are not always the highest earners. Often, they are the people who started before they felt confident, then learned as they went. The best time to start was yesterday. The second best time is right now. So let's bring this all together. A share is just a tiny slice of a company. An index fund is a basket of thousands of those slices. Pound cost averaging means investing regularly instead of trying to guess the perfect moment. And in the UK, a stocks and shares ISA can let that money grow tax-free. That is investing. Not gambling, not day trading, not some rich person's secret. Just owning small pieces of businesses and giving them time. And once you understand that, the whole thing becomes a lot less scary. If this finally made investing make sense, subscribe, because there's a lot more where this came from.